What is going on, investors? It seems like no matter where you look these days, someone is predicting a stock market crash. Are they right? Are they wrong? I tell you what, on today's video, we're going to take a look at the 5 indicators that are predicting a stock market crash. Indicator number 1 is exploding margin debt. Buying stocks on margin is just like buying something on a credit card. In this case, the broker extends you credit for an interest rate or a fee. Now, before apps like Robinhood came along, margin was actually something that was used by traders and investors with a significant amount of experience. Now, with a few clicks of a button, virtually any account holder has access to additional funds through a feature called Robinhood Gold. This has increased the number of investors that have margin debt, and increased margin debt has predicted stock market crashes. The reason high amounts of margin debt and stock market crashes go hand in hand because as stocks decline, the broker who extended you the margin or credit to buy those stocks forces you either to deposit money or forces you to sell those stocks as the value of that portfolio declines. In March of 2000, the S&P 500 and margin debt peaked shortly after the dot-com bubble had burst, and the market crashed and bottomed in the fall of 2002. 5 years later, in 2007, you guessed it, stocks were back at all-time highs, and so was margin debt. What followed was one of the most devastating financial crises the world has ever seen in 2008 and 2009. Since then, the stock market has not only recovered, it has soared. And you guessed it, while markets are at all-time highs right now, so is margin debt. Indicator number 2 is that valuations of stocks are near all-time highs. According to JP Morgan, the S&P 500 price to earnings ratio is 1.6 standard deviations over the 25-year average. In other words, stocks are way overvalued. When was the last time the forward PE was this high over its standard deviation? You guessed it, right before stocks crashed back in 2000. Now, virtually every indicator is flashing warning signs of stocks being wildly overvalued. According to Advisor Perspectives, an average of 4 historical stock market valuation metrics show the stock market is overvalued by 185%. The highest on record dating back to the dawn of the stock market. Indicator number 3 are stock buybacks. Companies buy back their own shares for a number of different reasons. Management will tell you it's a tax-efficient way to return cash to shareholders. Others will argue buybacks allow executives with huge share-based compensation packages to sell those shares back to the company on their dime. Additionally, by reducing the share count, management can elevate earnings per share without actually raising earnings. The fact is, executives of companies are far better at running the day-to-day operations rather than buying their own stocks at the most opportune time. The proof of this is based on the fact that stock buybacks have peaked right before the dot-com crash of 2000 and the great financial crisis of 2008, only for executives to stop buying as many shares once the stock started to go down. In other words, executives bought the shares high and didn't buy them when they were low. Over the past few years, you guessed it, corporations have been buying back stock at record numbers. If the markets begin to go negative again, don't expect these executives to buy back the stock, since it's not something they've been able to do during the past 2 crashes. Indicator number 4 is irrational exuberance. Most of you watching this right now might not even remember who is famous for saying this phrase, but it was none other than the former Federal Reserve Chairman, Alan Greenspan. During a speech in 1996, nearly 5 years before the tech bubble officially burst, the Federal Reserve Chairman, Alan Greenspan, uttered the phrase irrational exuberance when describing the escalated asset values driven primarily by internet stocks, which were all the rage at the time. Today, Many investors still feel tech stocks are wildly overvalued, but other assets are showing bubble-like tendencies, such as the housing market, cryptocurrencies like Dogecoin, and NFTs, which are essentially pixels on a computer screen, sometimes selling for millions of dollars. All of these are signs that irrational exuberance might be back in the markets. Indicator number 5 is inflation. Inflation is the decline of purchasing power due to rising prices. While some inflation is good for stocks and the economy in general, rapid or high inflation can lead to stock market crashes. While inflation erodes consumers' buying power and hurts people who are savers, the biggest impact on the stock market normally comes through higher interest rates. If the market believes inflation is coming, there's a general attitude to borrow money now and spend money now because in the future, those goods and services will be more expensive due to inflation. The Federal Reserve will then attempt to control the interest rates by raising them if they feel the economy will become too hot with borrowers, or lower interest rates if they feel the economy is too cold with savers. Recently, U.S. Treasury Secretary Janet Yellen made news by saying interest rates may need to rise a little bit to make sure the economy in the United States doesn't overheat. The stock market's major averages all dipped lower on those comments. She later walked those comments back, essentially saying it's not her job anymore to control interest rates, but the damage was done. The fact is, the market has been running under the assumption that Federal Reserve Chairman Jerome Powell has adamantly denied that the Federal Reserve is even, and I quote, thinking about raising interest rates. So now you have the United States Treasury Secretary and the Federal Reserve Chairman essentially disagreeing on which way interest rates are going to go. I tell you what, if the largest Federal Reserve Bank and the United States Treasury are unsure what rates and inflation will be in the near future, expect investors to flee to the sidelines. The most important thing to remember, though, as an investor, is to not panic about market crashes, since every investor will experience at least a few of them during their investing career. The key I have found is actually develop a plan now, because making decisions when markets are crashing is often driven more by emotion or fear rather than sound investing principles. And lastly, the market has signaled a correction for actually a pretty long time now. I remain fully invested until the signs are clear that the market is turning negative. Until then, have a plan, do not panic, and good luck with all your investments.